Although calculations and ratios can be asked in both papers, a detailed analysis question is usually part of paper 2. Take the time to work through the information provided carefully in detail, analyzing all of the information and coming up with any thoughts of your own while reading through it. This will make answering the individual questions later a lot easier. Information relating to growth point properties. Growth point properties ups dividend for 6 months and says environment remains uncertain. If they're upping the dividend, that simply means that the dividend has increased compared to previous payouts. Notice that we're looking at 6 months instead of a full year. And that's quite important. It's going to make a difference to the way that we do our calculations. And the fact that it's saying the environment remains uncertain is simply just referring to the economy or the economic environment. You can see a lovely picture of the V&A waterfront. I'm sure you might recognize that. Growth Point Properties, the largest primary JSE listed REIT, lifted its dividend 5.1% to 61.5 cents a share in the 6 months to December 31st, as it continued to reinforce liquidity, strengthen its balance sheet, and optimize its local portfolio and seek new revenue streams. Immediately think about, what do they mean when they talk about reinforcing liquidity? Liquidity is referring to cash flow. In other words, the relationship between your current assets and current liabilities. Strengthen its balance sheet. What is a balance sheet? Well, you should hopefully recognize that they're referring to the statement of financial position, which used to be called a balance sheet, although the International Financial Reporting Standard refers to it as a statement of financial position instead. Many people still use the term balance sheet. Strengthening the balance sheet simply means that obviously, if it's the representing the accounting equation, it means either your assets are going up or maybe your liabilities are going down. That would strengthen the financial position of the business. Chief Executive Norbert Sass said the solid performance was due to increased contributions from the V&A Waterfront, Growth Point Properties Australia, and improved South African finance costs due mainly to the November 2020 equity raise. What do we mean by an equity raise? That is obviously increased equity. In other words, a share issue. Growth Point's 50% interest in the V&A Waterfront, with its share of property assets valued at 8.9 billion rand, reported a 62% rise in net property income due to a partial recovery in international tourism. So this is interesting. They're showing us that the fact that they own 50% of the V&A, there's an increase in their net property income as a result of international tourism. Why? Because if you've got more tourists arriving, it means they'll spend more money at the waterfront, which is a very big tourist destination. Then it means that they will be able to receive more revenue. The Growth Point share price, which increased 4.1% to 13.42 early yesterday afternoon, remains undervalued compared to its South African net asset value of 2148 cents per share. The net asset value had increased by 6.2% by the end of the 6-month period. Look at these two figures and think about how you can compare them. Remember that we always want to compare the JSE price to the market price. In this case, the JSE price is quite a lot smaller than the net asset value. that indicates that there's a lack of investor confidence in the business. Remember that the JSE prices would be based on the supply and demand for these shares. And so obviously if the price is low, it means there's not a lot of demand because the investors probably don't recognize that it's actually worth that much, or maybe they think that the business isn't going to make a lot of profits. In line with an 80% payout ratio, Growthpoint retained 524.6 million before tax, ending the period with 515.8 million cash on the SA balance sheet and 6.2 billion rands of unused RSA committed facilities. What do we mean by an 80% payout ratio? What gets paid out? Obviously, dividends. So that means that if you're looking at the relationship between the total earnings and the dividends and what gets left over, we can do our useful little triangle here. We can say the total profits would obviously be the full 100%. If dividends or the payout is then 80%, it means that the retained earnings or the amount going to retained earnings would be 20%. You can see here we're also given our financial indicators. There's a current ratio and a debt equity ratio. If we look at both of these figures, what can you say about them? Now, these were obviously for last year because it's 2020, and we're actually concerned with 2021 financials. 0.89 to 1 means it's less than 1 to 1, which is usually considered rather poor because it means that it looks like they will be unlikely to be able to pay debts as they become due. Obviously, one would assume that since this is a big company, it's probably going to continue operating and all should be fine, but it is something that you would certainly worry about. Other things that you would need to consider and question are things like what is your inventory period? Now, obviously, for this business, they don't really hold inventory as such because they own property and they let the property out, which means we don't actually have to worry about the inventory period. So we can actually compare this. It's more similar to your acid test ratio for this particular company because there isn't really necessarily a lot of inventory, one would assume. The other things that you would consider is you would look at things like your receivables period and your payables period. And if you are able to get good terms from your suppliers, then it means that you can actually get the money from your customers or your clients, your tenants, before you need to pay your suppliers. And then it's actually fine to have a lower ratio. So you would want to look at all of those things as well. But these are the kinds of things that you want to think about. And immediately we can start seeing that there are some issues with this business. The fact that the shares are undervalued might be because the shareholders are noticing things like, oh dear, the liquidity is a little bit poor. The debt equity ratio, however, is also low, below 1 to 1. And in this case, this is actually a good thing. It means that there's a relatively low risk of bankruptcy. Because for every 1 rand that is owned or by the shareholders, there's less than 1 rand that is owed to others, banks or whoever the money has been borrowed from. So that's actually quite a good thing. It means that you would probably be seen, or the business would probably be seen as creditworthy, and they would be able to take out more loans if they needed to for any reason. You can see over here, we've got the financial statements for 6 months. Again, notice I've highlighted that it's 6 months for you because it means that these figures are not for a full year. So if you're going to do any calculations, you need to keep that in mind. Remember that we always need comparative financial statements. In other words, you want to be able to look at the figures for this year and compare it to the same figures for the previous year. Over here, we're not using the year, we're just using 6 months. And so what has happened is that you're given, obviously, for the 6 months ended 31st of December 2021, but then you're also given the same 6 months, in other words, the second half of last year. In addition, they've also shown you the 12 months all the way to the 30th of June 2021, so that you can see exactly what it was for the entire year. Obviously, those figures, as you can see, are approximately doubled because it's for double the period of time. Now we're going to just have a look at these figures, and now not all of them have been given in the comparative figures, but we can see some of them. If you have a look at the revenue, you can see that the revenue has actually dropped a little bit. It went from the 6,699 million rand to 6,376 million. So it's slightly lower than it was before. And then you can see what figures that is made up of. You've got property-related expenses, expected credit losses on trade receivables. What do you think that means? Now, I know the term credit losses might be a little bit unfamiliar to you, but it is actually a very common term that is used generally. And all that means, credit losses, is referring to your bad debts. So if we're talking about expected credit losses, that means expected bad debts. So you could actually equate that with the provision for bad debts that you would have maybe done as an adjustment. Obviously, it would be the adjustment in the statement of income. And you can see, interestingly, that it's an income over here because the 6 is positive. The net property income is given, as well as other operating and administrative overheads. Operating profit is then given as an answer here. So if you wanted to, if it helps, draw in your little total lines so that you can see what is actually happening with these calculations. How are they being worked out and what do they mean? You can then see there are also other adjustments after the operating profit, and it refers to fair value adjustments. Now, that's not something that is in your matric syllabus or curriculum, but it is something that you can sometimes be exposed to, because it is important for you to be able to see things that you haven't seen before and try and figure out what that might actually relate to. Fair value adjustments basically means that items were revalued. Your assets might have been revalued for some reason because they were actually worth more than what you paid. And although we do work on historical cost, it is possible to have objective valuations and then do an adjustment for fair value. And then obviously you can see your finance and other investment income and your finance expense. In other words, this is your interest income and your interest expense. Those are just the nice terms for it. That then gives you your profit before tax and your taxation, and then you arrive at how much was actually being left over. Now, have a look at what happens to these figures. Along the way, you can see that compared to the exact same 6 months in the previous year, the operating profit also went down, which is kind of to be expected if the revenue went down. But suddenly, look what happened here. The profit before tax has increased hugely. It's actually changed from a loss to a very big profit. So you want to then go and have a look above and see what might be the reason for that. And if you look up, can you see that that is the amount that changed hugely? And that would be the reason for it. And that is your fair value adjustment. Obviously, you can see tax, and tax has also changed. Now, obviously, the tax is shown as a percentage of the profits, whatever the profits might be. And so you can see in this case, the taxation is certainly bigger than it was last year because the profit was bigger. So you would expect the tax to be bigger. Interestingly, last year, there was a loss made, and yet there is still tax. And you might be going, why on earth are they paying tax if there was a loss? That tax might have referred actually to the previous year. If they had slightly miscalculated the previous year's tax, then it might be shown over there. If we look at the statement of financial position in exactly the same way, you can look at your non-current assets and you can see they've increased a bit. Your current assets have increased quite a lot. So you can see that something's obviously going on there. We don't know if maybe the liquidity might have improved. We'd have to go and work it out. But in fact, if you look at the liabilities, you can see they've also increased quite a lot. So it's more just a case of obviously the business is growing and needs more working capital for whatever reason. If you look at the equity, you can see that the share capital increased. And remember, that was the equity raised that they spoke about. It's because of your share issue, obviously. So yes, there definitely was a share issue, and those figures there back up the statement that was made in the news article. You can then see you're given non-current liabilities, and note that the specific amounts for interest-bearing borrowings are given. What do we mean by interest-bearing borrowings? Quite simply, that is just your loans. So we're talking about any money that you've borrowed that you have to pay interest on. And again, that's increased, but so slightly, it's kind of negligible. The current liabilities we've already looked at as quite a lot. And now we can see a little bit more information about the long-term borrowings. On the left, you can see information that would have been obtained from the notes to the financial statements, and you can see the interest rates on lots and lots of money that was borrowed by Growthpoint. Now, what's interesting here is that you can see that they borrow money in South Africa as well as in Australia and the United Kingdom. And South Africa, you can see there's secured rates and unsecured rates, and unsecured is simply means that they don't have collateral or a bond or something. There's no assets acting as security for the loan, and therefore the interest rate would be higher for those. Notice what's interesting is that in Australia and the United Kingdom, your interest rates are a lot lower than what they are in South Africa. On the right, you can see what the South African interest rates were for this period. Now, the current date is December 2021, and it actually helps to make a little note for yourself of where you are right now. And then your comparative figures would have been over here. That would have been last year's date. And so therefore, the relevant prime interest rates would have been 7 and 7.25%. Right, so now that we've looked at all of that information, we can now work through the questions. I know it takes a little bit of time to go through all the information like that, but you'll see that we've actually answered a lot of questions without even realizing it as we worked through it. So what is required? You've been provided with the financial information from Growthpoint Properties Limited's interim results for 6 months. And you can see over here that I have actually highlighted for you the fact that it is for 6 months, just to make sure that you realize you're going to have to take that into account in your calculations. Keep in mind that the financial period is only half a year rather than a full year for all your calculations and answers. Number 1, study the statement of income for the 6 months. So let's go and find the statement of income, and here you can see it. Calculate the net property income as a percentage of revenue. Now, I know this is something that you've never actually calculated before, but that doesn't matter. You use some common sense. All it means is that you would show your net property income over your revenue, and you would work it out to get a percentage. So if we go and have a look at the statement of income, we can obviously see revenue at the top here. And we're working on the 2021 year. So obviously revenue of 6,376 is going to go at the bottom. Keep in mind that that is millions of rands, that as long as I'm doing calculations where I'm using this, all of them in millions of rands, that's fine. It might, however, be safer to write it like that, just to be sure that you don't get confused. If we have a look at net property income, you can see this is the line over here. And that was the answer that we achieved when we said revenue minus property-related expenses. So you can see we'll put on the top 4,639 million. If you work that out, you should get 72.76%. Make sure that you always work to 2 decimal places, because otherwise your answer is not going to be complete. Now, this is a very different kind of layout. What do you think that equates to? Have a look at the next question. Why do you think this figure is so high compared to many other gross profit margins? In other words, I'm showing you that this figure here kind of equates or is similar to gross profit for a trading business, because it's taking your basic revenue and subtracting the costs that are directly related to that revenue, including, interestingly, the expected credit losses on trade receivables. Now, we normally just show that as part of other income, but it is possible to put it over here because obviously it does relate directly to the revenue, so it's quite a sensible way of showing it. Now, why do you think that this figure might actually be so high? Normally, a gross profit percentage is maybe 50% at the most, maybe 25%, obviously depending on what industry you're in. Keep in mind, what is this business? This business owns property and rents it out. Now, when you own property and you rent it out, it means you're not going to have that many expenses as you would if you had bought stuff and sold stuff. So make a note of the fact that the main income is rental income. And there are not a lot of costs associated. Okay. Obviously, when you're writing your answers, you would want to put it in more detail. I'm just doing very short little notes for you over here, but you need to make sure that your answers are in great detail and very specific. Use full sentences and explain yourself very carefully. Did the provision for expected credit losses, in other words, bad debts, increase or decrease for this period? Now, this we've actually looked at already. And I've given you the term here because I said provision. So just in case you hadn't picked that up for yourself, I've actually shown you that that figure relates to the provision for bad debts adjustment. Now we can see over here that the adjustment amount was a positive figure. If we look at the negative asset of the provision for bad debts, it's a negative asset, which would be plus minus, and you would work on the minus side. If we have got a credit of 6 in the statement of profit or loss, that means that it would have had to be shown over here as the adjustment, which means that the original balance got smaller as it went from last year to this year. So it would have decreased. And the reason for that is simply that the adjustment is an income. You can also specify the amount. Always try to make a point of specifying the figures, quote figures. That makes your answer more thorough. The profit for these 6 months is significantly higher than in previous periods. Now that's if we go and have a look over here, we can see the profit. Either you can look at the profit before tax or the profit after tax. Both of them you can see are significantly higher. What item accounts for this improvement? Quote figures. Now, luckily, we've already looked at this because we immediately saw that, hang on, there's a huge change from last year to this year. And we worked it out as, oh, look, our fair value adjustment is the reason. So it's just asking for what item. It's not asking you to explain. You don't have to worry if you don't understand it fully, as long as you can identify that the item is the other adjustments, fair value, etc. of the 4,233 million, then that is going to help a lot, because that's showing you it's a 4,233, which is better, yet it was a previous loss or expense of the Rand 3,960 million. And the way that the marks would be allocated here is firstly identifying the item and then quoting the two figures. This item includes revaluation of assets. Considering the nature of Growth Point's business, what is the nature of their business? They own property. And the economic climate over these periods, think about what happened in 2020 and 2021. The economic climate was hugely shadowed by COVID. So what would have accounted for the change? If you give it a little bit of thought, you'll realize immediately there was COVID, and so you can specify that in your answer. And as a result of COVID, the property values fell. And the reason for that is because many people were working from home. And so offices were empty and shops weren't being used. Why would taxation have been only 82 million, but as much as 1,260 million for the same period in 2021? So that's looking at this over here. And the answer is obvious. Remember that taxation is a percentage of profits. And because the profits increased, obviously the tax would increase. Question 2. Consider the statement of financial position as at 31st of December 2021. You can see over here, they've just requoted the information about the dividend that was increased. And it's talking about the liquidity, strengthening the balance sheet, etc. Perform a calculation to support the claim that liquidity has improved. Using figures from the 6 months ended 31st of December 2020 and 2021. So, to find out liquidity, you should immediately be thinking, liquidity is relating to your cash flow. In other words, you want to look at your current ratio. Do you remember that the current ratio was actually given to us right at the beginning over here? So we can use that current ratio and point out that in 2020, the current ratio was 0.89 to 1. And now we would need to calculate for 2021. And the way that you calculate the current ratio, it's actually quite a beautiful one, because the word current gives you a very good clue that you need to use your current assets compared to current liabilities. So in this case, you will use the current assets of 9305 and the current liabilities of 9140. That then gives you the ratio of 1,02 to 1. And what you can see over here is that it has actually improved. So the situation is definitely better, and that backs it up. To what financial statement does the balance sheet refer? Now, interestingly, you can see that in the quote, Norbert Sass was talking about the balance sheet, but over here, it has been called a statement of financial position as required by the International Financial Reporting Standard. So hopefully you recognize that, and then that's a nice, easy question where you're simply going to specify that it is the statement of financial position. You're then asked to calculate the debt-equity ratio. The debt-equity ratio is one of my favorites because you can easily see what goes into it, even if you don't have your formula sheet with you for some reason. The debt is simply your non-current liabilities, obviously, non-current liabilities compared to your equity, because it says equity. So all we need to do now is take the non-current liabilities, and specifically we're looking at our loans. The total non-current liabilities over here, we're looking at the 7434 compared to the equity of 88603. And that gives you 0.7921. And can you see that that is less than it was last year as well? So this has also improved. Okay. We can then look at the question that says, do you agree with the statement that the company is in a healthier financial position? Justify your answer. Well, looking at the current ratio and the debt equity ratio, I would definitely say yes. Sometimes it's better to actually conclude with a yes because you want to make your arguments first. So I would immediately say the debt equity ratio has decreased or has improved. So now there's lower risk. It means there's increased equity in relation to the borrowed. So it means that the value that is actually owned by the shareholders is stronger than what it was before. Question 3. Consider the loans used by Growth Point Properties. And remember, we already identified, here are the loans. Calculate the effective interest rate on interest-bearing borrowings or loans. And you can see over here, I've specified that those are the loans for the 6 months ended 31st of December. And your answer needs to be per annum. To work out the interest rate, all you'll need to do is go and fetch the interest from your statement of income, and you can see it is here as your finance expense. So the 1573 will need to be used at the top, compared to the amount of the loans. And ideally, you want to actually average it because the amounts did change over the 2 years. So the best answer would be to use both of these figures. Although in reality, when I marked this question, I did accept if only one was used. If you calculate that, you will then see that you get a rather large interest rate, which seems a bit higher than what you would expect maybe. Don't forget that you need to say times, well, sorry, it would have been quite small because it's only for 6 months. You would have only got about 2.5%. Remember that you need to adjust for the fact that it's only for 6 months. So you would say times 12 over 6. And that is then going to give you 5% per annum. Make sure you show your percentage. Make sure you specify PA for per annum. What was the prime interest rate in South Africa for this period? Remember that we already highlighted it over here. We can see that the prime interest rate was 7 to 7.25%. Which means that the effective interest rate of Growthpoint is actually a little bit lower, but keep in mind that that was because of Australia and the UK that impacted it. What might account for the difference between the interest they paid and the prime interest? Well, there you go. You're starting to see why it's quite nice to think about these things before you actually look at the questions, because we've already got the answer. Quite simply, some of the loans were foreign. They were from Australia or from the UK, where the interest rate is much lower. Calculate the return on capital employed for the 6 months. Again, note that we've got to watch out because it's asking for 6 months. Return on capital employed is another one that you can work out very easily. The word on simply means put a line. I love that. Return means you're looking for what came out of the business. In other words, profit. Capital employed is all the money that got invested in the business. In other words, your equity and all your non-current liabilities. Interestingly, do you see that this figure over here is made up of the same figures that we used over here for the debt-equity ratio? Keep in mind that because we're comparing the statement of income to the statement of financial position, and statement of income is for a period of time and SFP at a period of time, remember that you want to average your beginning and your end figures. The other thing to keep in mind is that because you're using the non-current liabilities, you actually want to use the profit before the interest on loans, because it doesn't make sense to use it afterwards, because obviously if the money had been invested by owners instead of being borrowed, you wouldn't have incurred that interest. So now you can go and fetch all the figures that you need for that. We'll get the profit obviously from the statement of income. And you can see over here, we've got the profit before tax, and we would then adjust backwards with the interest on loan. You're going to need to use both of those figures. So you'd say your 6,999 million plus the 1,573 million, and divide that by half of. Now we go and get our equity. You can see there are our equity numbers, and we use both the beginning and the end. So we'll say 88,603 plus 80602. And then we also need to say plus the average of the non-current liabilities. And here's the non-current liabilities. We're going to use the 70434 and the 68465. Of course, you don't have to average them separately. Sometimes it's a lot easier to actually just say, instead of putting it like that, don't close brackets and just add all of them in together and then halve it. That's actually a faster way of doing it. Once you work it out, you should see that you get an answer of 11,13%. In other words, for every rand that is invested in this business, 11% is coming out. Now, if you compare that to the interest that we worked out of 5%, what can you see? It means that we can borrow money at 5%, earn 11%, pay the 5% back, and we actually make a profit of 6% on everything that we borrow. So we want to be able to borrow money because it's profitable for this business. Comment on the gearing and use of loans. Gearing is referring to your debt equity or the quantity that is borrowed. It's how much has been borrowed. In other words, the use of the loans. And what would you recommend regarding further loans? Immediately, I would comment and say that this business is positively geared. Keep in mind that positively geared refers to the fact that you've compared your return on capital employed to the interest rate, and the return is bigger than the interest rate. That means it's positively geared so that loans are profitable. And that means you want more loans. In addition, you can also point out that it's relatively lowly geared. And so therefore, you'd be able to get loans. And obviously develop these ideas, write nice full sentences, because it is for 3 marks. So you need 3 solid ideas to get those full 3 marks. In line with an 80% payout ratio, Growth Point retained 524.6 before tax, ending the period with 515.8 million cash on the balance sheet and 6.2 of unused RSA committed facilities. Remember, we spoke about the payout ratio, and we referred to the fact that the payout ratio is talking about the dividends. Question 1 says, based on the information provided here, calculate the dividends for this period. Remember that we actually showed a little triangle explaining how we could actually work this out, because we'd already predicted this. If you're trying to work out the dividends, that means that this over here is the figure that you want. We've got a figure of 525.6 million given to us. 524.6 million. Now that amount is the 20% that was retained. So I'm going to put 20 at the bottom, and I'm going to show I want to get the dividends. The dividends will be the 80. And then you can work it out that it would have been 2098.4 million rands that were paid out. From that, we can then go and work out the number of shares if we know that the dividends per share were 61.5 cents. Because remember that the dividends per share equals the actual dividend, the 2098.4 million, divided by the number of shares, which we don't know, and we know that that equals 0,615. Always make a point of taking your cents and turning it into rands so that you don't get confused in your calculations. You can then solve for X and see then that the number of shares would be 3,412,032,520 shares. Another way of working that out, if you wanted to, could also have been using your figures for equity and net asset value. You would actually get a different number because obviously some of the calculations that we're doing are more simplistic, and so there would be other factors involved as well. The Growth Point share price, which increased 4% to 13.42 Rand early yesterday afternoon, remains undervalued compared to the South African net asset value of 2148 cents per share. The net asset value had increased by 6.2% by the end of the 6-month period. Remember that this was where we were looking at investor confidence. And we picked up that the investors are not that confident in this business. And we now need to think about how we're going to respond to our answers. The article claims that the JSE share price was undervalued. Do you agree? Now, I would certainly say it is likely that you would say yes, simply because of the fact that your JSE price or market value is smaller than the net asset value, which indicates that there's a lack of confidence. It indicates that the shares are being sold, are bought and sold for less than what they are worth on the statement of financial position. It could, of course, also mean that maybe your assets in your statement of financial position are overvalued, but that's unlikely because of things like historical cost and needing to be objective and the fact that the financial statements are usually audited, although obviously the interim statements here haven't yet been audited. On the other hand, you could say no, because maybe the shareholders actually expect that the shares are worth less because they don't think that there are going to be many profits because of the poor economy, because of COVID, etc., etc. One could argue like that, but the reality is they are actually undervalued because they're worth less than the net asset value on the statement of financial position. Make sure that you elaborate to get 4 marks here. You need to use full sentences and discuss in detail. The last question then says, one of the asset items listed in the complete statement of financial position, although it's not shown here, is property held for trading and development. Would this be included as part of current or non-current assets? Now, what you need to look at is obviously property. Yes, we normally assume property is a non-current asset. However, it says held for trading and development. Trading means buying and selling, and specifically buying and selling in the normal course of business. And if it's in the normal course of business, it means it's part of your operating activities, which means that this would actually be a current asset. And that is actually where it was shown.